using NOI versus cap rate to analyze commercial deals. When it comes to evaluating commercial real estate investments, two of the most important metrics investors rely on are net operating income, NOI, and the capitalization rate, cap rate. These metrics not only help you assess the current performance of a property, but also determine whether a deal is worth pursuing. At Venus Venture, we use both NOI and cap rate as core tools to identify value, spot opportunity, and negotiate with confidence. Let's break down what they mean, how they work together, and why understanding the relationship between the two is critical for making smart investment decisions. What is NOI? Net operating income, NOI, is the annual income generated by a property after all operating expenses are deducted from the gross income, but before financing costs and taxes. Formula: NOI = gross income, operating expenses. Operating expenses typically include property management fees, maintenance, insurance, utilities, if paid by the owner, property taxes, and other ongoing costs. Debt service, loan payments, is not included. NOI reflects the true income-generating potential of the asset, making it a vital number when comparing deals or tracking performance over time. What is cap rate? Capitalization rate, cap rate, is a percentage that indicates the expected rate of return on an investment property based on its NOI and current market value, or purchase price. Formula: cap rate = NOI, purchase price. For example, if a property generates $100,000 in NOI and is priced at $1,250,000, the cap rate would be $100,000, $1,250,000, = 8%. Cap rate helps investors quickly compare different opportunities and gauge whether a property is fairly priced, overpriced, or undervalued. How NOI and cap rate work together. To analyze any commercial real estate deal, you need both metrics. Here's how they're used in tandem. 1. Estimating property value. If you know the NOI and have a target or market cap rate, you can estimate the property's value. Value = NOI/cap rate. Example: if a building produces $120,000 NOI and comparable assets in the area sell at a 6% cap rate, then $120,000, 0.06 = $2 million, estimated value. This formula helps determine if a listing price aligns with market conditions. 2. Evaluating the asking price. If you know the asking price and NOI, you can calculate the cap rate and see how it compares to other deals. A higher cap rate might indicate more income relative to price, but also potentially more risk or a property needing work. A lower cap rate might suggest a safer or more stable asset, or simply that the market is hot. Using these metrics in value-add deals. At Venus Venture, we often pursue value-add opportunities, assets that aren't operating at full potential. In these cases, the current cap rate may appear low, but that's not the full story. We analyze the pro forma NOI, the income the property could generate after improvements. This allows us to estimate future value and potential return on investment. Example: current NOI, $80,000. After renovations and lease-ups, NOI increases to $120,000. Market cap rate, 7% future value, $120,000. 0.07 = $1,714,285. If we purchased the property for $1,200,000 and spent $200,000 on improvements, that's a $314,285 gain in value, excluding rental income or appreciation. Limitations to consider: cap rate doesn't consider financing or tax impact. For that, metrics like cash-on-cash return or IRR are better. NOI assumes stable operations. Sudden vacancy or unexpected repairs can skew results. Market cap rates vary by location, asset type, and risk profile. Final thoughts. NOI and cap rate are essential tools for commercial real estate analysis. Used correctly, they provide quick insights into a property's value, performance, and risk profile. At Venus Venture, we combine financial metrics with deep market insight to uncover undervalued opportunities and structure deals that maximize upside. Whether you're evaluating a core asset or a value-add play, understanding how to use NOI and cap rate together is key to making data-driven, profitable decisions.